Okay, so we've got this MKDW stock, right? And on April 7th this year, 2025, it just went crazy, like over 200% up. But then you see, like just a year before that, and it's down like 95%. It's a crazy drop. So you sent this whole stack of stuff about it. And honestly, we're kind of curious too, like what's going on with MKDWELL Tech Inc?
Yeah, that kind of like a wild swing in the price. It tells you there's got to be more to it. It makes you wonder, like how stable is this company really, and what are the chances it'll be around long term?
For sure. So for this deep dive, we're looking at all the stuff you sent, the research reports, news articles, everything on MKDWELL Tech Inc., ticker MKDW. It's an automotive electronics company, went public through a SPAC back in July 2024, and now it's trading on NASDAQ. We want to cut through all the noise and see what's important, like their business model, how good the management is, how they're doing financially, and what the market thinks.
Yeah, not just the obvious stuff. We got to know who owns a lot of the stock, and super important, what are the big risks for the company going forward? Think of it like we're detectives looking for clues in all these documents to figure out what's really going on with MKDWELL. We want to find those things that make you go, aha, that explains why the stock's doing that crazy stuff.
Totally. We'll be looking at the good parts of this industry, automotive electronics. It's a hot area, no doubt, but also the problems that MKDWELL seems to be facing. So let's dive in, starting with the basics. What does MKDWELL actually do? Chapter 1, Business Understanding.
Okay, so what's interesting right away is where they came from. They started as MKD Technology back in 2006 in Hsinchu City, Taiwan. Then last year, 2024, they became MKDWELL Tech Inc. after combining with Cetus Capital Acquisition Corp. And that's when they listed on NASDAQ with the MKDW ticker.
And they're not just in one place, incorporated in the British Virgin Islands, but their main operations are split between China and Taiwan. That kind of like global setup isn't unusual these days, but it adds a layer of complexity with rules, supply chains, and even political stuff.
Definitely. You see, MKD Jiaxing in China does both the research and development, R&D, and the manufacturing, which makes sense to keep things efficient. Then MKD Taiwan in Hsinchu, that seems to be their tech center. Hsinchu is known for being a science and technology hub, so having R&D there could be a real advantage.
Now, for their products, it's surprisingly diverse. They make these intelligent control systems specifically for RVs, and that could be big with RVs becoming more and more popular these days. Then there's LiDAR sensors. Those are super important for all those driver assist systems, ADS, and for self-driving cars in the future. They've also got intelligent container control systems for logistics, and even vehicle seat controls for comfort and safety.
What stands out is that they're not just going after one kind of vehicle. They're targeting passenger cars, commercial vehicles, RVs, even logistics vehicles.
Yeah.
They're casting a wide net, maybe to reduce risk and not depend on just one part of the market.
Right, and it's not just selling ready-made stuff. They do ODM and OEM customizations, too. They can basically tailor their technology to exactly what other car manufacturers want, which could lead to some solid long-term partnerships.
Yeah, that's smart. Being able to sell both off-the-shelf stuff and custom solutions opens up more of the market for them and lets them build deeper connections with their clients.
So where's the money coming from? Looks like most of their revenue is from those direct sales of the electronics and systems we just talked about. But a good chunk also comes from those customized ODM and OEM services. This is where we see a bit of a warning sign, though. In the past, they also made money from what they called commission processing and rental income. Both of those have dropped off big time lately.
Yeah, that drop in the commission processing, they're saying it's because they ended some relationships with some big customers. And that tells us they've been really relying on just a few clients. Losing those deals, well, it hurts their sales immediately, the rental income going down, maybe not as dramatic, but it also shows some kind of shift in how they're doing business.
Exactly. One of the things we read pointed out how much they relied on these key customers before, which makes losing them even more worrisome. Now, about how they actually make these products. They've got that design center in the Hsinchu Science Park, again, a big tech spot. And then the actual manufacturing happens in Jiaxing Science and Technology City over in China.
So they've got their design and innovation in a high-tech place like Taiwan, and then they're making this stuff in China. That's pretty common for electronics companies these days, combining expertise with potentially lower production costs.
And they make a point of saying they're all about high-quality manufacturing, meeting industry standards. In the car world, where safety and reliability are super important, that's not just a nice thing to have. It's like you got to do it to survive.
Right, meeting those strict car industry standards, it's not just about making a good product, it's about navigating all the complex regulations and making sure you're following the rules. That can be a huge hurdle for new companies trying to break in.
So finally, where do they fit in the market? It seems like they're going for specific niches within the bigger automotive electronics world, things like controls for RVs, LiDAR for certain ADS applications, and those logistics management systems. They're selling the idea of complete solutions that combine their sensors with their own customizable software, and they talk about this module design concept, which they claim lets them respond quickly to what customers need and keep costs down.
Yeah, going for niches can be smart for a smaller company trying to get established in a competitive industry. And that modular design approach could be a good way to stay flexible and price their products competitively.
Okay, so on to chapter 2, management evaluation. Who's running the show here? Well, leading the way is the founder, Ming-Chieh Huang. He's the CEO and chairman. Almost 24 years in semiconductors and automotive electronics, plus degrees in both information engineering and management. Sounds like he knows what he's doing.
Yeah, having a founder with that much experience is a big plus. They often bring a long-term vision and a deep understanding of both the technology and the market. Combining engineering and management education, that's also super valuable for leading a tech-focused company.
Then there's Minji Ku, the CFO since 2022. Her background is also electronic and information engineering. She's got a bachelor's degree in it. So it seems like someone with a technical mind is keeping an eye on the financials.
Yeah, in a tech-heavy field like automotive electronics, having a CFO who understands the tech side can be a real benefit. They'll probably have a better grasp of R&D costs, investment needs, and the financial side of all the tech advancements.
The third big name is Min-Chao Huang, the general manager and an executive director. He's been with them since 2012, managing operations. He's listed with a vocational high school degree.
So we see a mix of educational backgrounds in the leadership team. It'd be interesting to think about how these different perspectives and experiences might shape their decisions.
On the board of directors, there are 3 independent members, Jixiang Tang, Changyi Sun, and Zhongta Chang. Having independent voices on the board is usually a good thing for making sure the companies run well and looking out for all the shareholders.
Yeah, those independent directors are important for providing a different perspective, questioning management's ideas, and ensuring that what the company's doing benefits all the shareholders.
So how have they been doing performance-wise? This is where it gets a little bit weird. One source mentions 16.4% revenue growth over the past year. Sounds pretty decent, right?
It does, but we got to look closer at the specific time periods and get more detailed data to really understand how they've been performing recently.
Yeah. When we focus on the first half of 2024, it's a different story. Revenue down a huge 61.3% compared to the year before. Net loss grew almost 78%, and the gross profit margin took a hit, dropping from 15.2% down to 8.2%. That's a big concern.
That's a big difference between that yearly growth and the huge decline in the first half of 2024. Seems like any good growth they had has been wiped out by recent problems. That sharp drop in gross profit margin is especially worrying points to potential issues with how they're pricing things, how much it costs them to make their products, or both, affects their profitability.
They're blaming those losses on 2 things. Cost related to listing on NASDAQ, which is usually a one-time thing, and more importantly, losing a key customer. That customer alone made up over 22% of their revenue the year before.
The NASDAQ listing costs, yeah, those won't happen again. But losing a customer that big, that's a real setback. It doesn't just hurt immediate sales, it can affect their future growth and how much of the market they control. Makes you think about how much risk they have with depending so much on just a few customers.
So how did the management team handle this sort of crisis? They actually decided to end the relationship with that big customer in 2024. They said it was overpricing disagreements after they reviewed the business. Then they shifted to trying to find new customers, a lot of whom were still in the early stages of testing their products. This definitely hurt their revenue right away.
That's a bold move and could be really risky. They basically walked away from a big chunk of guaranteed income, hoping to get better deals with new clients who weren't making them much money yet. Shows they're willing to make tough choices, but also highlights how uncertain things are when you rely on unproven customers.
From what they're saying, before the NASDAQ listing, a lot of their focus was on getting listed. Now that that's done, they say they'll prioritize growing the business, getting new customers, and improving their product quality. This change is super important if they want to make it, but it's happening while they're already in a tough spot financially.
Sounds like they might have put more importance on going public than on making sure the business itself was strong. Going public can help them get money and attention, but it doesn't mean they'll be successful. Their future depends on how well and how fast they can find new customers and start making money again.
What about how open they are about all of this? Well, they did release some financial numbers for the first half of 2024, not the fully audited ones, but along with explanations from management about why revenue went down and what their new plan is. They also put out press releases about the NASDAQ listing. But one thing we read pointed out that the level of detail they give and how often they talk to investors might be different from what we usually see with established U.S. companies.
Yeah, that's a good point. As a foreign company, they might have different reporting rules than a company based in the U.S. Investors need to realize that they might not get the same level of detail or as many updates as they're used to.
As for whether they're ethical, we didn't see anything majorly bad. But they did mention some agreements to convert debt into stock, and this involved people connected to the company, the CEO, his wife, and something controlled by one of the directors. Deals like this always need a closer look to make sure there are no conflicts of interest and that everyone's being treated fairly.
Definitely. Any deals involving people connected to the company, those need to be examined carefully. It's not that they're automatically wrong, but it's crucial to make sure they're done like they would be with anyone else, and that the terms aren't better for the connected people than for other shareholders. Good corporate governance practices are key to managing these potential conflicts. The fact that they have a code of business conduct and ethics is a good sign. It sets out what's expected in terms of behavior.
Last thing on this corporate governance. We know the board has both company executives and independent members. But you should know that MKDWELL chose to follow what are called home country practices instead of some specific NASDAQ governance standards. This means they don't have to follow all the same rules as U.S. companies on things like how often independent directors meet or the specifics of shareholder meetings.
That's important for investors to get. Choosing home country practices can give foreign companies more flexibility, but it also can mean less oversight than U.S. investors might be used to. Something to think about when weighing the risks and rewards of investing in companies like this. They do have an internal audit function that reports to the board, which is standard for managing risk and oversight.
Okay, Chapter 3, Financial Health. Let's really dig into the numbers now. Like we said before, the info varies a lot between sources, probably because of different reporting times and all the recent stock price craziness. Starting with their market capitalization, we saw numbers from as low as $2.85 million all the way up to $74.70 million, all as of April 7th this year. That big range tells you how unstable things are, like we saw at the beginning of this deep dive.
Yeah, that huge difference in market cap just shows how much the stock price has been jumping around. And it might even be that different sources are reporting the data differently or updating it at different times. Just goes to show how uncertain their current valuation is.
And the price-to-earnings ratio, or PE, is all over the place too. One source has it at a negative 8.04, another at 900. Quick reminder, a negative PE usually means the company isn't making a profit. The E for earnings is actually negative.
Right. Negative PE means they've had a net loss. The positive figure could be from a different reporting period, maybe a time when they did make a profit for a bit, or it could even be based on predictions of future earnings, which are always uncertain, especially considering how they've been doing lately.
When you look at their revenue growth trends, it's not good. We saw that massive 61.3% drop year over year in the first half of 2024, and for the whole year, revenue was down 45.5%. So it's going down, and not just a little, it's shrinking a lot.
Those are big revenue drops, and they're definitely a worry. A downward trend like that is hard to turn around. It affects everything, how much they can invest in growth, their relationships with suppliers and customers, everything.
And their profit margins are getting squeezed too. The gross profit margin, that's what's left after you take out the cost of making the goods that fell to just 8.2% in the first half of 2024 and just a little better, 8.3% for the whole year. Even more worrying, their operating and net profit margins are negative. They're losing money on their main business and overall.
Yeah, those tiny and negative profit margins mean they're having fundamental problems turning sales into profits. Their revenue just isn't enough to cover their costs, and that can't last forever.
Let's talk debt. Their debt-to-equity ratio is crazy high, some reports say over 1,800%. Basically, they've got a mountain of debt compared to what their shareholders own. This much debt makes them much riskier financially.
A debt-to-equity ratio that high, that's a major warning sign. It means they're relying heavily on borrowed money. If interest rates go up, or they don't start making more money to pay back that debt, they'll be in trouble. And it also limits what they can do financially.
Their ability to make cash is also a problem. Free cash flow, that's the cash a company has left after paying for operations and maintaining its assets, it's negative. One report had it at negative $1.32 million for the past 12 months. They're burning through cash.
Negative free cash flow will drain a company's reserves fast. Then they have to find more money, maybe by taking on more debt or selling more stock, which can hurt the people who already own stock.
Lastly, the price-to-book ratio, or PB, it's pretty low at 0.37. A low PB can sometimes mean a company is undervalued compared to what its assets are worth. But with MKDWELL, considering all their other problems, it probably means people are really worried about how much those assets are actually worth, or whether the company can even use them well. Could mean the market thinks those assets might have to be sold off for less than they're valued at on the books.
Yeah, a low PB combined with them not making a profit and all that debt usually means the market's really unsure about the company's future.
To sum up their profitability and balance sheet, they're not making money right now. They reported net losses for both the first half of 2024 and the full year. Their balance sheet looks shaky too. As of June 30th, 2024, they had a working capital deficit of over $4.8 million, basically. Their short-term debts were bigger than their short-term assets. They've also got over $12.6 million in accumulated deficits, which means they've been losing money for a while now.
A working capital deficit can cause serious cash flow problems. Makes it hard for them to pay their bills on time. And those accumulated deficits show how hard it's been for them to consistently turn a profit.
And probably the scariest thing we saw in all the documents, as of June 30th last year, their total liabilities were actually bigger than their total assets. This made their auditors say they have substantial doubt about the company's ability to continue as a going concern. In finance, that's a really bad sign. It basically means that if things don't change big time, they might not survive.
Yeah, a going concern warning. That's serious. It means their financial troubles are bad enough that people are questioning if they can stay in business. Any investor, whether they already own the stock or are thinking about it, should take that very seriously.
Okay, before we get to the second half, where we'll look at market sentiment, ownership, and risks, want to tell you about a great tool that can help you do this kind of deep analysis whenever you need it. Ever wish you had a bunch of financial analysts ready to break down complex stock info for you? That's what stockanalytics.ai is all about. It's like having AI-powered research on demand. It goes through tons of financial data, news, and expert analysis, and gives you clear, concise insights, just like what we're doing here. Whether you're researching a new investment or just trying to stay informed, stockanalytics.ai helps you cut through all the noise and understand what really matters. Sign up at stockanalytics.ai. That's stockanalytics.ai.
So let's move on to Chapter 4, Market Sentiment. Given all the financial issues we just talked about, what MKDW stock has been doing is pretty confusing. We said earlier that on April 7th this year, it went up a crazy amount, over 205%. But over the past year, the stock is down a massive 95%. These wild swings really make you think, what's driving this kind of volatility?
Right. It's wild. And it gets even more confusing with the beta numbers. One source said it was 2.17, another said 0.58. Beta tells you how much a stock's price tends to move compared to the overall market. A beta over 1 usually means it's more volatile than the market average. So even with the different numbers, both suggest that MKDW can swing up and down a lot, though how much is debated.
Yeah, those different beta figures, it goes back to the inconsistencies we've seen in other data points. It's tough to get a perfectly clear picture, so investors have to be careful about relying on just one source of information. The takeaway is that this isn't a stable, low volatility stock.
What might have caused that giant price jump on April 7th? The trading volume that day was enormous. 222.96 million shares traded, compared to an average of 1.92 million. That's a huge spike in activity. It seems like a lot of investors suddenly got interested, maybe because of speculation or some news or rumor, even though we couldn't find a specific reason in our sources for that day's jump.
That kind of volume usually happens when there's big news, maybe an analyst upgrade, or even just a sudden shift in how the market sees the company, possibly because of social media or short-term trading trends. It means something made a lot of people want to buy or sell the stock right then.
Remember how those market cap numbers varied a lot between sources? Well, that just highlights the uncertainty around the company's value and how fast things are changing. What's also interesting is that in some places, there are no analyst ratings or price targets. That could mean the company's too small to get noticed by the big analysts, Or maybe the analysts are holding back because of all the financial instability and volatility.
Yeah, no analyst coverage, that can be a sign in itself.
Mhm.
Maybe the company doesn't fit what big research firms are looking for. Or maybe the analysts are waiting to see what happens with the company before giving their opinions.
One source did a quick comparison of media sentiment, and for MKDWELL, it was neutral, actually a little better than what they found for one of their competitors. So at least from that small sample, the news coverage wasn't super negative.
Neutral media sentiment, especially when they're having financial problems, could be because there's no really bad news besides the earnings reports themselves. Might also mean the company isn't getting much attention in the financial news, good or bad.
We also looked at Reddit, specifically our trading analytics. There was talk about market volatility due to those new tariffs that were announced on April 2nd. Traders were feeling cautious overall. MKDWELL wasn't mentioned specifically in what we saw, but it's important to keep in mind that big economic factors and how investors are feeling can affect individual stocks, especially risky ones.
The tariffs are relevant because they could impact the entire car industry. Supply chains, production costs, and even demand for automotive electronics could be affected. The cautious mood in trading forums reflects a general nervousness in the market that could make stocks like MKDWELL even more volatile.
There's also a StockTwits page for MKDW, where people share their thoughts and opinions in real time. It can give you a quick sense of how investors are feeling right now, but remember, it's mostly speculation and not professional financial advice.
Yeah, platforms like StockTwits can show you what retail investors are thinking, but it's often very short-term focused and might not be based on solid research. Take it with a grain of salt.
Let's move to Chapter 5, Ownership Structure. Knowing who the big shareholders are can tell us about a company's stability and where it might be going. One source said that 70% of MKDWELL's stock is owned by institutional investors. Another source said insider ownership is 22.9%. That's a lot of stock held by the company's own management and insiders.
A lot of institutional ownership can be a good sign. It can mean big, experienced investors think the company has potential in the long run. But it can also make the stock price more volatile if those institutions decide to sell. High insider ownership can be good if it aligns management's interests with the other shareholders, but it can also be a problem if it means management has too much control or there's not enough independent oversight.
We looked at some SEC filings too, specifically Schedule 13DA. Those are required when someone buys more than 5% of a company's voting shares they have to disclose their ownership and what they plan to do. For MKDWELL, these filings shade that some key people own a lot of stock, like Ming-Chia Huang, the CEO, and entities like CETA Sponsor LLC, which was part of that SPAC deal that took MKDWELL public.
Those Schedule 13D filings are important for transparency. They let you see who the major players are and how much they've invested in the company. Looking for changes in these filings can give you clues about possible shifts in control or big changes in investor sentiment.
Here's an interesting thing. There's a recent filing, April 3rd of this year, that shows some current holders want to sell up to 100 million shares. This kind of secondary offering can mean a few things.
Yeah, a big offering like that could mean early investors or people inside the company want to cash in some of their profits. It can also dilute the ownership of existing shareholders because there'll be more shares out there, which can sometimes push the stock price down. Makes you wonder why they'd want to sell right now.
Okay, on to Chapter 6, Risk Assessment. We didn't see a formal SWOT analysis in the stuff you sent, but we can figure out the strengths, weaknesses, opportunities, and threats for MKDWELL based on everything we've looked at. Weaknesses first. Hard to ignore that big drop in revenue and the fact that they keep losing money. The shrinking gross profit margins are bad news, and so is losing that major customer, which shows how vulnerable they are to losing just one or two big clients.
Absolutely. Their financial performance is definitely weak. Not growing revenue and losing money, those are big problems. Relying on just a few big customers has been a problem for them, and it's still affecting their bottom line.
Then there's the debt. Their debt-to-equity ratio is through the roof, and that means bigger interest payments. The working capital deficit and those doubts about them staying in business, it's all pretty scary in terms of their financial stability. Compared to the big players in automotive electronics, their brand isn't well known, and they don't have much market presence. And their returns on invested capital ROE and ROC being negative, that means they're not doing a good job making money for investors.
All those balance sheet issues and the lack of profits, those are big hurdles for them. A weak brand makes it harder to compete and keep customers. And the negative returns on capital show they're not using their money effectively.
What about threats? The automotive electronics space is getting crowded, especially with new companies focused on electric cars. And the rules are always changing, covering things like safety, emissions, even cybersecurity. Keeping up with that is a constant challenge, and it costs money. We also can't forget about those trade tensions and tariffs. Those could hurt the car industry in general, which would affect them, especially with their operations in different countries.
Yeah, all that competition, especially from new electric car companies with lots of money, that's a big threat to the established players.
Hmm.
Navigating the regulations and keeping up with all the changes, that takes a lot of resources and expertise. And tariffs or trade restrictions could mess up their supply chains and make it more expensive for them to do business.
Customer switching costs, that's interesting. They do offer customized solutions, which could make customers less likely to leave, but they did lose a big customer recently, so maybe it's not that hard to switch. And even with the stock jumping up recently, the overall sentiment towards MKDWELL is something to watch, especially given their financial problems.
Yeah, good point. If their custom stuff isn't really unique or tightly integrated into what their customers are making, it might not be that hard to switch. And like we've seen, the market can change its mind quickly, especially if the company isn't performing well.
Now, for opportunities, they are in a market that's growing fast because of electric vehicles, those advanced driver assist systems, and all the connected car tech. The fact that they can customize, do ODM and OEM means they can meet the specific needs of their clients, and those needs are always changing, could be a big advantage. Their module design concept could help them stay efficient and adapt quickly. Being in the Hsinchu Science Park gives them access to innovation and talented people. And even though they're struggling right now, being listed on NASDAQ could give them more visibility and help them get more money in the future if they can convince people they can turn things around.
You're right. The automotive electronics market is growing, which creates opportunities for companies like them. Being able to customize lets them target specific needs in the market. And being in a tech hub like Hsinchu helps them innovate and find good people. The NASDAQ listing does open up possibilities for future funding, but they'll need to show investors a clear plan to improve.
Lastly, their strengths. They do have a dedicated research and development division, and that's essential to stay competitive in this fast-moving industry. They've got design and manufacturing facilities in important places, Taiwan and China. They've built expertise in areas that are growing, like LiDAR and intelligent control systems. They've got patents, which means they've got some unique tech. And like we talked about, there's at least some potential for switching costs to make customers stay.
Having that R&D division and manufacturing capabilities in those key regions gives them a solid base to work from. Being experts in new technologies like LiDAR is a definite plus, and those patents protect their innovations and can make it harder for competitors to copy them.
All right, Chapter 7, Brief Conclusion. Putting it all together, MKDWELL is in an industry with a bright future, but they're facing some really strong headwinds. Revenue's dropping, losses are growing, they've got a ton of debt, and there are serious doubts about whether they can even stay afloat. That recent huge jump in the stock price is definitely something to think about, but you gotta remember how poorly the stocks performed over the past year.
From a value investing standpoint, based on what we've read, MKDWELL doesn't have the things value investors look for: consistent profits, strong advantages over the competition, and solid financials.
And that brings us to our end hook. So given all this, the question is this recent jump in MKDW stock a real sign that they're turning things around, or is it just a temporary bump on a long and difficult road? What can we learn from this about the risks and rewards of investing in the ever-changing world of automotive technology? If you want more deep dives like this, subscribe to the Stock Analytics AI YouTube channel. And a quick reminder, the information we've shared is based on available research and AI analysis. It's not financial advice.
Yeah, this look into MKDWELL shows how important it is to go beyond just the stock price and really understand how a company's doing, especially with smaller, volatile companies in a fast-changing industry.
Here's a final thought for you. MKDWELL's corporate structure is complex, spanning different countries, and they rely on both direct sales and customized services. How might big economic or political changes around the world affect a company like this differently than a competitor that's focused on one country? What hidden risks or even unexpected advantages might come from doing business globally when the whole world's economy is changing?
That's an interesting question. Being global like that creates both risks and opportunities that a local company might not have.
Thanks for joining us today. We appreciate you spending your time with us. If you have any insights or questions about MKDWELL, please share them. And if you found this helpful, subscribe so you don't miss our next deep dive. We'll link to all the sources we talked about in the show description.